Welcome to Money Inside Your Minds, an AML Watchers web series where we will talk about people who have seen financial crimes up close. People who have experienced it, studied it, investigated it, and most importantly, what they have learned from it. Real insights, real lessons, and real world perspective from people working in AML compliance and financial crime prevention. Today's conversation is about something every institution struggles with sooner or later. How do you rebuild trust after things go wrong? How do you design compliance that actually works in practice, not just on paper? And what recent enforcement actions are quietly taking place in the industry about which the regulator should know? I'm your host, Muzzamil, and joining with me today is John Christmas. John has seen the system up close, spent years thinking critically about where compliance breaks down and how it can be done better. John, thanks for joining us today on Money Inside Your Minds.
Hello, Muzzamil. Thank you for inviting me on Money Insider Minds. I have a unique perspective on this. It's not exactly about how to do compliance within one country, but more how to look out if you're a banker, to look out so you don't end up accidentally cooperating with a rogue bank, like a bank in a country which is operating in a rogue way, and where, in this case, even the people within the government were on the side of the rogues and protecting them rather than enforcing the law against them. I was whistleblower against a bank in Eastern Europe where two things were going on: large-scale money laundering that was connected to the Kremlin, and also embezzlement, or specifically their commercial loan portfolio was, much of it was loans to insiders. I'm the co-author of a book called KGB Banker. I'm also co-producer of a documentary called Banker's Game. And my experience included real meetings with American intelligence and British intelligence and even Russian intelligence. So I have some firsthand knowledge about what goes on there.
Thanks, John. Let's move into the core of today's conversation. We want to keep this grounded in experience and practical thinking, and with the experience you just mentioned, this conversation would be really insightful. So we'll start with trust. Specifically, what happens after a compliance failure, how institutes respond, and what actually works when it comes to rebuilding that credibility. So in your view, how can banks and financial institutes rebuild trust with regulators, clients, and stakeholders after a major compliance breach?
Well, the way the agenda is written and my personal experience does not exactly match up. But what I can say is that my function with this bank in Eastern Europe was both to liaise between the bank and the ratings agencies, which was a big issue. And another thing was to liaise with the banks from the West and also banks from Asia who were our partners. So banks from Asia or from the West would send representatives to our bank in Eastern Europe, and I would be the person to meet with them. They told me they purposefully selected me because I'm American and because they wanted to give a Western face to our bank, and to make them comfortable that everything was with proper governance and proper AML within our bank, so that the counterparty banks would trust us with things such as establishing trading lines with us, also opening correspondent accounts for us, and also lending money to us. We were recipients of a couple syndicated loans where Western and Asian banks made loans to our banks, and that money disappeared. And also the banks that were our correspondent accounts, those banks were probably quite nervous after my bank collapsed, thinking, are they going to get penalties because they had correspondent account services to my bank?
So, John, the thing is, after the financial breach has been done, how do you rebuild the trust?
Well, I think from the standpoint of the Western banks that get duped into this, like suppose you work for a bank and your bank offers correspondent banking services, that is payments in a different currency, to this Eastern European bank, which turns out to be uh, a rogue bank, uh, the way to be careful in the future is to know some of the tricks that I'd say the Kremlin uses to make a bank appear to be legitimate, even though it's not, because you don't want to be in a position where your bank suddenly is in trouble because billions of dollars of illicit funds went through a correspondent account at your bank, and you trusted the bank in Eastern Europe to open up that account.
So, what you have seen from the industry, how do institutions typically respond after a high-profile compliance failure, and where do you think they fail short?
Well, in this case, again, the rogue bank did not actually get punished in any way. It got bailed out, and nobody was prosecuted, and nobody was fined. In fact, the government literally spent billions of euros on the bailout. So, for them, the recovery wasn't such a problem, but it still is a big problem to be avoided, taking a whole global look at it, that you don't want to have these rogue banks out there. And you don't want, if your bank is an honest bank, you don't want to be caught accidentally or unknowingly cooperating together with a rogue bank. Some of the things that my bank did to get trust from the Western and Asian banks were simple things such as having a Big Four auditor and having ratings from the major ratings agencies. And this is a thing where I used to have trust in these organizations, and I don't anymore. But it brings up the whole issue that a rogue bank itself pays its auditors and itself pays the ratings agencies. And therefore, a Western or Asian bank going into Eastern Europe who sees big name companies as the auditors and the ratings agencies cannot get a lot of comfort from that, because it is the Eastern European banks themselves who are paying these people, and therefore they get favorable audits and favorable ratings. But these do not necessarily reflect what's really going on within the Eastern European bank.
So, transparency. One word that keeps coming up in serious compliance conversation is transparency. You can see that in here. It sounds simple, but in practice, it's often one of the hardest things to get right. So, the importance of transparency in building effective compliance programs. How important is transparency in building trust and creating an effective compliance culture inside an organization? You just told me that Eastern Bank was paying the Big Four auditors, and they were paying for the rating firms. So, how important is transparency, keeping in this in view?
Well, with transparency, my experience is the Russians, or you could say the money launderers for the Kremlin, they make extensive use of front people, which is, you could say, a fight against transparency. For example, setting up Western shareholders and Western people within the bank in order to make the bank appear to be Western, even though it's not. One example is with shareholders, to try to bring in minority shareholders who are respectable shareholders. So you don't have a bank that's solely owned by an individual oligarch, but rather the bank shows who its shareholders are, and shows, in our case, a fund from Sweden, a fund from Finland. These are shareholders. So people might think, oh, well, if this fund from Sweden is an owner and this fund from Finland is an owner, they can't possibly be Russian money launderers. But this is done on purpose to bring in respectable shareholders. Another one, which wasn't at my bank, but some of the other banks I'm familiar with used it, is bringing in people on the board of directors who are not bankers, but rather are, you could say, anti-Kremlin people who give the appearance that the bank couldn't possibly be laundering money for the Russians. For example, one of the banks I'm familiar with, in fact, convinced a former prime minister of Denmark, who also served as general secretary of NATO, to be on their board of directors. So this is something where they would have told the banks, of course, you can trust us because this guy is obviously against the Kremlin, and you know, he has a high level of integrity because he was the prime minister of Denmark. But it turned out that he didn't really know what was going on at the bank, and they used him as a front. So this kind of thing, the money launderers don't want transparency. They want to trick you. So they'll on purpose bring in shareholders or board members. And in the case of board members, obviously they're paying these people and they're not telling these people that the bank is rogue. And in the case of shareholders, the biggest intransparent thing which I saw was so this bank where I worked, where I became whistleblower because they were making large loans to insiders and those loans did not get paid back. So you could say they were fake assets. That a way they covered up fake assets is by bringing in a shareholder that was a multinational development bank. So this multinational development bank, which has a reputation for doing good things, was the shareholder, but then it was determined through leaked reports from the government, also from even there are documents from Eurostat and the European Union which show this, that in fact that development bank was not a normal shareholder, that instead of paying to purchase the shares, it was the opposite way, where the government of the country secretly paid them to say that they purchased the shares. So they were set up as a straw owner or a front owner, and this fooled a lot of people. So in the realm of transparency, sure, it would be better that the board of directors are people who are real bankers who really know what's going on inside the bank and they're not duped front people. And also that the shareholders are institutions that know what's going on in the bank and they invested purposefully because they believe the bank has a good future ahead of it, and not people who decided to invest because someone secretly handed them the money.
You have just told us how does fake transparency look in a bank, in an institute. So from your experience, what does real transparency in compliance operations actually look like? Not in theory, but actually in day-to-day practice.
Well, the real transparency would be, for one thing, not to have the insider loans, or if you do have some small amount of insider loans, you can have some insider loans if you disclose them to be insider loans, but there are limits on that. I mean, it can't be all of the loans. It only can be a small portion of them. So ideally, they would do that transparently. I mean, in the case of my bank, they didn't do that because they were actually embezzling the money. So they were on purpose making the loans to fake companies set up by themselves. And then on the level of the shareholders, yeah, I mean, it is good to have diverse shareholders. You don't want to be a pocket bank for a particular oligarch. A way not to be a pocket bank for any individual person is to have diverse shareholders so that there's not one person who controls the bank. So if there are many owners and the many owners are all interested in the success of the bank, then of course they wouldn't be interested to have one oligarch making loans to himself. So that's much better to have diversified shareholdings.
John, have you ever seen a situation where transparency in AML or compliance program actually helped reduce risk and strengthen relationship with regulators and stakeholders?
Well, some of the talk about risk that I came across was used in a tricky way. And I'm sorry to be negative when I'm talking because much of what I experienced in banking was negative. But I've found that Eastern European banks all the time will say something like, oh, obviously we're fighting against money laundering because obviously we don't want this risk. We don't want to have the risk of getting fined by the government or even prosecuted. We don't want to have the risk of losing our reputation by being caught in a money laundering scandal. But they would kind of say they're trying to avoid the risks. But I didn't actually see much risk at least in the country where I was working, because the country wasn't punishing people for money laundering. So you could say that if you can make a lot of money from money laundering and there's not really a risk because the regulator is corrupt and won't look into anything anyway, that there's not really a risk to it. And then from the outsider perspective, like if you're from a Western bank or from an Asian bank, which is doing business with other banks in Eastern Europe, then you really want to be serious about avoiding risk. And that's where you need to be careful about really understanding the banks that are your partners in Eastern Europe to make sure that those partner banks aren't aren't faking their compliance and aren't really money launderers, and in the worst cases, even money launderers connected to the government in the Kremlin.
So let's bring this into the present. Enforcement actions often reflect what regulators care about most, sometimes more clearly than the formal guidance. As we move through 2025, what enforcement actions stand out most in the financial crime and in AML space?
At the bank where I worked, there was one significant enforcement action, which was very disappointing, but is good to mention because this is something that really goes on. And I apologize, I'm a little bit sick today if I cough or something. But there was a case, it was a United States Department of Justice case against Daimler-Benz for paying bribes to sell buses in several countries, including in my country. And the United States Department of Justice did not go through with prosecutions. Instead, they did a settlement. So they did a settlement, which at that time was the largest settlement that the U.S. Department of Justice had ever gotten from a foreign company. It was Daimler-Benz had to pay more than $100 million penalty to the United States government because of paying these bribes. But an unfortunate thing is that none of the people who were the actual criminals involved got in trouble in any way, and they got to walk away with the money. So the people who got punished were everybody who owns stock in Daimler-Benz, which is more than 1 million people owns shares of Daimler-Benz in their pension accounts or wherever. They were the ones who ended up getting punished, even though they had nothing to do with it. And the individual people who were negotiating the bribes, paying the bribes, and receiving the bribes did not get punished. So that was an enforcement action, which is far too common these days, where the United States or other countries do this also. Decide to crack down on something, like something goes wrong at a publicly traded company and they decide to punish somebody, but the people who end up getting punished are innocent shareholders who didn't know what was happening, as opposed to the actual criminals. I would like for that to change in the future. Of course, it would be much better for society and a much better deterrent if the people paying and receiving the bribes would be the ones who got punished. But so far what I've seen is that often governments find it easier to reach a settlement where the shareholders get punished and not the crooks.
What are the key lessons compliance teams should be taking from these enforcement actions right now?
Well, if you're representing an Asian or a Western bank and you're going into Eastern Europe and you're offering services such as correspondent banking services is a key one, or if you're making loans to banks in that area, or if you have trading limits with banks in that area, you need to be prepared that the Eastern Europeans will sometimes be trying to trick you. And some of it would be about getting the biggest name auditor and the big ratings agencies on their sides. And you just need to keep in mind that they are paying the auditor and the ratings agencies. Another thing is to set up unbelievable shareholders where the shareholder turns out to be some famous, respectable individuals or institutions that perhaps don't really know what's going on in the bank. So just because they're shareholders doesn't mean that the bank is necessarily legitimate. A red flag to look out for is people who load up the banks in Eastern Europe that load up the board of directors with people who are not bankers, but rather people who are there for the image. For example, people who are associated with Western governments or associated with NATO, and then they join the board of directors. And you're supposed to think, well, this bank cannot be possibly a Kremlin money launderer, because why would this high official from NATO be on the board of directors? But you could also ask, well, why does a high official from NATO need to be on the board of directors anyway? He's not a banker, so he's there
to establish credibility, basically.
And another one, which is a telltale sign, which people all missed, and I don't know how they missed these things, is there are certain banks in Eastern Europe. I mean, all of the banks claim to be legitimate banks. They say they're legitimate retail banks serving honest depositors and honest borrowers in these Eastern European markets. But if a bank has a team of high-paid lobbyists in Washington, to my thinking, this is a red flag. So if a bank really is only doing domestic business in a small Eastern European country, then you would think that Washington would have no interest in this. Why would it even matter to Washington?
Why do they need Western lobbyists basically in a bank?
But yeah, the lobbyists, when there is a team of lobbyists, and the lobbyists often are specifically charged with talking with the U.S. Treasury with a specific goal of the bank not getting blacklisted, you would think that a normal retail bank wouldn't even have the need to convince the U.S. Treasury that they're not money launderers, because if your activity was really just legitimate business within your country, the U.S. Treasury wouldn't even look at you. I mean, it wouldn't be an issue.
Based on what we're saying, how can institutions avoid falling into the same patterns that continue to lead to regulatory actions?
Well, one of the things that I was thinking about that should be a red flag to every bank that provides correspondent banking services, and this is a big issue in the world because there are fewer banks every year that are offering this in United States dollars, for example, because they don't want to take on the risk that they find out mafia money was moving through the correspondent account that they are holding. If the volume of money going through a correspondent account is way higher than what you would expect from the normal commercial activity taking place in that country, it's an obvious red flag. You could estimate what based on the size of the economy of a country, you could estimate what the level of transactions in US dollars or in other currencies could be. And if you find out that the actual amount of money going through the correspondent accounts is way higher than any commercial activity that's actually going on in that country, it would be a red flag that this money is not from their domestic economy, and this is some international scheme, and it's not normal banking business.
Okay, to close things out, based on everything we have discussed today, trust, transparency, risk, and enforcement, what's the one mindset shift compliance team need to make if they want to stay ahead rather than reacting after the damage is already done?
Well, I wish that the mindset within banks and within governments as well would be to stop the money laundering, to acknowledge that money laundering is a big risk, especially with rogue governments that threaten other countries that have a lot of stolen money going around in their slush funds, that this is a risk to everybody, that everybody is at risk by the ability of rogue governments to launder large amounts of money. So the mindset of the bankers and the mindset of the regulators as well should be to try to stop it. I mean, also with insider lending, if the people within the bank realize that their bank is not making loans to arm's length companies, but rather is making loans to insiders, and the loans are not even predicted to be paid back again, that this is a threat to their country. I mean, in the country where I was working, there was actually a national economic collapse that followed the looting of the bank. So if you're in a country and you're patriotic about your country, you want to have a safe future for the world, and you want to also have a successful economy for your country, when you see things like large-scale embezzlement and large-scale money laundering, you should take action against it to expose it. And I wish this would be the mentality of the people within the bank and the people within the regulator as well. Sadly, it's not that way all the time. It is that way sometimes, but not all the time. And hopefully people will wake up to the potential dangers from this and do more honest banking in the future.
John, thank you so much for sharing your perspective and insight. This has really been a thoughtful and grounded conversation. And to everyone listening, this is Money Insider Minds. Short conversation, real insights from people who have seen the system from the inside. We'll see you in the next episode. Thank you so much again, John, for joining in.
Thank you, Muzzamil.